A billionaire who dodged cameras, ran empires from hotel suites, and whispered deals that reshaped fortunes, then slipped away before the flashbulbs even warmed up. That is Dieter Bock, the phantom investor who turned discretion into a business model and discipline into a fortune. The man's legend starts with silence. While others collected magazine covers, he collected deeds, shares, and options, moving through boardrooms like a shadow. He did not perform success, he compounded it. He preferred hallways to red carpets, minutes to interviews, numbers to adjectives. The press learned to call him reclusive. Associates called him precise. He never mistook attention for value. And that single habit, resisting spectacle, explains a great deal about how he became rich. He grew up in post war Germany, where rebuilding was not a metaphor, but a daily task. The country taught an entire generation to respect order, thrift, and the long view. He trained in law and taxation, the twin languages of corporate reality, and began his career advising others on how to structure, protect, and optimize their businesses. Those early years were a masterclass in incentives. He saw how the right vehicle could shield a balance sheet, how a little leverage could safely amplify returns, how cash flows from slow, dependable assets can be worth more than flashy gains that come and go. Instead of leaving that knowledge on the invoice, he put it to work. At first, he moved in the modest corridors of commercial property, small office buildings, logistics parks, and mid range hotels that looked ordinary to outsiders and essential to occupants. He prized assets with boring cash flows, long leases, predictable maintenance, tenants who paid on time because their livelihoods depended on it. He liked structures that separated operations from ownership, and ownership from personal exposure. Little by little, one property became a handful became a portfolio, and the portfolio became a web of holdings across Germany and neighboring markets. The pattern was simple: find assets the public markets ignored, price the risk correctly, lock in financing on conservative terms, and behave as if the next downturn starts tomorrow. If you are enjoying this story, please subscribe to the channel and give a like to help us keep growing. As the portfolios got heavier, the strategy got lighter on ego and sharper on math. He sought partners who valued confidentiality and outcomes. He built relationships with banks that understood he would rather overpay for safety than underpay for trouble. He hired managers who could squeeze waste out of utilities, occupancy, and procurement without squeezing tenants into flight. And he developed a reputation for showing up with solutions, not speeches. In property, especially in Europe, patience is not a virtue, it is a weapon. You win by waiting for price to meet discipline. He waited well. Eventually, the radius widened from buildings to businesses. If a company's value was trapped under old ownership, if a stable brand had become a cluttered conglomerate, if a great set of assets needed a fresh capital structure, he was interested. He liked puzzles where the pieces already existed. The trick was to rearrange them. That is how he stepped into the wider world of public equities and boardroom politics. Block stakes, advisory roles, and the kind of quiet influence that rewrites a corporate plan without the drama of a hostile campaign. The most famous of those forays led him to London, where he took a significant position in a storied African focused conglomerate listed on the stock exchange. The company was vast, complicated, and bruised by years of boardroom wars. He did not come roaring in to break it apart on television. He arrived like a chess player, adding order to chaos, pruning portfolios, simplifying finances, and urging management to pursue the core businesses with clarity. In time, he served in senior non-executive roles and helped redirect a ship that had drifted in too many directions. When the time came, he exited with the same quiet he had arrived, leaving behind a company closer to the ground than the gossip. That London episode dramatized his approach. Undervalued complexity is an opportunity, not a trap, if you know how to count. He preferred clean narratives inside messy realities. He knew that sometimes the best way to make money is to avoid trying to look clever, and instead do the obvious things others have postponed. Sell distractions, fix balance sheets, stop promising what cannot be delivered, and let the numbers tell you when to leave. Back in continental Europe, his property interests continued to swell. Hotels figured prominently, not because they were glamorous, but because they combined real estate discipline with operational levers. A well-run hotel is two businesses at once, a building whose value you can defend, and a service engine whose margins you can improve. He liked that duality. He could install managers who treated housekeeping schedules and breakfast supply chains with the same seriousness as debt covenants. He could reinvest in energy efficiency to lower costs permanently, rather than slash staff and harm service. He could negotiate franchise relationships where the flag brought bookings, but the owner kept control over the key economics. When the cycle turned down, he carried prudent reserves. When the cycle turned up, he did not overshoot. Along the way, stories multiplied about his personal habits. He kept to a small circle. He lived for long stretches in hotels rather than country houses. He was punctual, almost ritualistic, about work hours and briefings. He answered questions directly, and if he did not intend to answer, he said so. He was allergic to empty superlatives, wary of lobbyists bearing shortcuts, and unimpressed by rooms that measured themselves in chandeliers. The myths made him sound austere. In truth, they described a professional who knew where to spend attention, not on the optics of a deal, but on the plumbing. So how did Dieter Bock get rich? Strip the legend down to its load-bearing walls, and you will find four simple moves that he repeated. First, he built from the ground up with instruments he understood. Legal and tax training gave him an X-ray view of risk. He structured deals to survive bad weather. He used modest leverage and long-term horizons. When an asset's value depended on patience, he had patience. When a structure's safety depended on discipline, he had discipline. That combination, knowledge plus temperament, turned ordinary properties into compounding machines. Second, he hunted for underloved complexity. Many investors hate complicated stories because they are hard to pitch. He loved them because they are often mispriced. Conglomerates with mismatched parts, companies with legacy disputes, portfolios tangled in old financing. These were the places where a quiet shareholder could create value without performing heroics. He did not confuse complexity with brilliance. He simplified. Third, he treated reputation as a currency. If bankers believe you never miss a payment, financing costs go down. If counterparties believe you do what you say, deal friction goes down. If managers know you will not chase headlines, execution risk goes down. That is not sentimentality, it is compounding mechanics. Lower friction repeated over years becomes a moat. Fourth, he understood when to vanish. In cyclical businesses, an exit is as important as an entry. He did not fall in love with trophies. He let numbers, not nostalgia, decide. When the math said the upside had narrowed and the downside had fattened, he reduced exposure. Avoiding one catastrophic loss can fund many years of quiet gains. Critics, of course, saw something else. To them, the quiet investor archetype looks like a euphemism. They say value investors are really asset strippers in a better suit, that cutting and simplifying often means redundancies and closures. They say secrecy can hide concentration risks and friendly arrangements. The fairest portrait is nuanced. He did not play the villain or the saint. He played the probabilist. He did not promise painless turnarounds. He promised solvable ones. The turning points in his career rarely looked like fireworks. They looked like term sheets and 10-year spreadsheets. One year, it was a portfolio refinancing that eliminated a floating rate time bomb. Another year, it was a sale of a cluster of non-core assets that freed capital for a better bet. Another year, it was a patient accumulation of a boardroom position that turned influence into outcomes instead of into headlines. He took pride in engineering resilience rather than spectacle. Because he distrusted spectacle, a different kind of legacy followed. Employees remember the checklists, the punctual calls, and the no-nonsense reviews, where underperformance was not shamed, but dissected. Partners remember straightforward appraisals of what a project could and could not do. A few recall the rare flashes of humor, dry and surgical, that pricked hot air before it warped judgment. He carried himself like a custodian of assets, of promises, of people's time. There were storms. European real estate cycles are unforgiving. Financial crises can rip tenants away, turn refinancing into a cliff edge, and expose the difference between theoretical covenants and practical relationships. He navigated those stretches by pre-negotiating trust. If lenders believe you are not playing for the short term, you have more room to pivot without breaking. If equity partners believe you will not outsmart yourself, they give you room to think. If your own team believes you will not flinch from hard adjustments, they steady their hands. The London chapter taught another lesson. Global markets reward truth-telling. When a conglomerate has wandered, an honest simplification plan beats a flashy growth plan. He pushed for the boring virtues that markets in the end always reward: clarity, focus, cash flow. That is how you turn a stake into a fortune without needing a drumline to announce it. His personal style of wealth was more balance sheet than billboard. He favored tight ownership structures over sprawling empires with thin skin. He concentrated where he had edge and diversified where he lacked it. He converted paper gains into hard reserves and kept his cost of living out of the headlines. He spent cultural capital sparingly, reserving favors for when they truly mattered. In short, he made himself hard to hurt. Because he made himself hard to hurt, he had time, and time in compounding is a superpower. A single unbroken decade of conservative free cash flow reinvestment will outrun a decade of brilliance, interrupted by one ruinous blow-up. In property especially, the calendar is your ally if you keep your debt tame and your ego tamer. He did both. There is a human coda too. In his later years, he kept working from the same routines, with the same small circle, the same preference for hotels and direct meetings. He did not slow down so much as compress, focusing on what he liked best: sharpening portfolios, mentoring lieutenants, and refusing to be distracted by the theater of business. His death came unexpectedly, and the headlines finally found him for a day. Then the news cycle moved on, and his work went back to being what it had always been: visible mostly to those who counted the rent, the payroll, the debt service, and the dividends. What then can a founder or investor learn from Dieter Bock? Start with silence. Noise inflates expectations and compresses margins. Practice the art of not performing. Focus on checklists that predict whether an asset will behave in the real world. Who pays you, how often, with what covenants, and what you can do when they do not. Treat leverage as a tool, not a thrill. Debt can be a bridge or a noose. Decide which before you sign. Use fixed rates when the tide is low, and avoid stacking maturities in the same year. Rehearse the downturn before you chase the upswing. Respect complexity, but do not worship it. Complexity is a place to harvest mispricing, not to polish your ego. Go in to prune and clarify, not to posture. Professionalize reputation. Pay on time. Return calls. Be honest about bad news. Those habits drive down your cost of capital, which quietly drives up your returns. In that sense, ethics and economics are not enemies. They are compounding partners. Exit like an adult. Sell because the thesis played out or failed, not because the headlines turned. An orderly exit is a sign of strength, not of weakness. Take your wins with the same calm you applied to your entries. Above all, play the long game. The world is full of loud sprints. Real fortunes are usually quiet marathons. The crowd admires the moment of victory. Professionals admire the years of not dying. And that is the paradox of his life. The quieter he stayed, the more the numbers spoke. The fewer interviews he gave, the more credibility his word carried in the rooms that mattered. The less he chased prestige, the more influence he accumulated in markets where prestige can be an expensive hobby. He built wealth the way a civil engineer builds a bridge. Calculate the loads, choose the right materials, test the joints, and refuse to cut corners just because the sky is blue today. Tell that story any way you like. Mystery man, hotel billionaire, the silent partner with the sharp pencil, and a single through line survives every edit. He made a habit of being prepared. That habit allowed him to buy resilience at a discount and sell clarity at a premium. It turned ordinary assets into extraordinary engines and turned a private man into a public case study in how to be rich without being loud. In a time that confuses attention with achievement, Dieter Bock built a counterexample. He proved that you can turn down the volume, double down on discipline, and let the arithmetic do the talking. His empire did not need a spotlight to run. It needed only time, patience, and a man who understood that most of the world's value hides in the unphotographed minutes where decisions are made, contracts are signed, and capital is quietly put to work. Déjanos tu opinión del tema en comentarios. Arriba tienes más vídeos para seguir aprendiendo.